Hi, my name is Nicole Allen. I'm a CPA at Insight CPAs and Financial in Bloomington, Illinois, and I'm going to be talking to you about tax return preparedness for 2013. I know a lot of you here are sole proprietors, so I'm going to give you an overview on both individual and business level, so when you put it both together, you'll be able to get a better picture of where you stand for taxes. So we're going to talk about the American Taxpayer Relief Act of 2012, which incorporates your 2013 tax preparedness. And I'm going to talk about the new tax brackets, capital gains and dividend rates, as well as how itemized deductions and exemptions have been changed, and different business expensing rules as well for fixed assets. So we're going to go deeper into those and show you how they affect you on the personal and business level as well. So the topics that I'm talking about are coming from the tax laws passed by Congress and signed as enacted into law by President Obama on January 2nd of 2013. All the information that you're about to hear is the most accurate and up-to-date information for your 2013 tax preparedness. All right, so most of you here are the sole proprietors. So most of your business aspects for tax purposes are going to flow through to you on a personal level. You know, at the business level, there's not a whole lot that really changed, but that it flows onto your personal taxes on a personal level, and that's really where your taxes are. So I'm going to kind of cover more of some of the personal things that kind of offset your business income. And so the big thing that everybody is pretty much concerned about is they have the new top bracket of 39.6%. That's all they hear is, oh, they raise the tax brackets, that's the highest bracket now. But I kind of wanted to give you all some perspective on what the tax brackets are, and if you're not familiar with how that they work. I'm thinking most of you are married. So on the bottom port there, you have the married filing jointly. So the brackets, they range from 10% to the new 39.6%. And what that means is there's brackets of income, so steps of income levels that are taxed at these different rates. So your first married couple, your first $17,850 has a 10% federal income tax. And then your next step up between 72 and the 17,000, that's the 15% on that amount plus the 10% of the amount before. Because a lot of people don't really think about that in that aspect. You just think of what's my tax rate. So that's kind of something to keep in mind through the rest of the presentation, because a lot of the new tax laws that are in place for 2013 are based off of your different bracket levels. So if you know that your income is going to be in between the $17,000 and the $72,000 combined for you and your significant other, then you're going to be pretty much 15% on anything that you earn in excess with your business. So kind of keep that in mind for yourself business-wise too, is knowing how much tax you're going to have and what bracket you're in. Okay, how much do I have to earn to get bumped into the next bracket? I'm really close to this bracket. Should I hold off and maybe push some income into the next year? That's kind of an end of the year tax planning thing. But knowing those and being familiar with them as a business owner, I think is invaluable for tax planning and purposes when you're going through the year of keeping an idea of, you know, how much money did I really make? How much money do I have to push back to the government at the end of the year? So keep those in mind, and then I'll kind of float back through the rest of it. Everything is pretty much the same from last year with the addition of the new tax bracket, which breaks off, well, for your married filing jointly, at $450,000. It's the 1% that they, you know, throw around that make over that. Those are the people that will get affected by the new tax rate. A lot of you'll probably be pretty similar to the prior year as far as your tax rates and how that goes. So that's kind of the boring stuff and the numbers that I like. All right, so moving into the personal side of things, everybody's asking about the capital gains rates and the dividend rates. In 2012, it was set to expire that the capital gains rates and dividend rates were going to go up. So they did a little modification to it. So if you sell stock or business equipment, it's a capital gain if you sold it for more than you bought it for. With you selling those, if you are in the 10 to 15% bracket that we talked about before, the capital gain tax on that sale is 0%. So you get a break there if you sell stock and you make a gain on it and you're in that bracket. If you are in the 25 to 35%, it's 15%. So it's still lower than your bracket rate. You get a little break. And then what they're talking about, the big hit that people are with the higher income, over $450,000 manual filing joint, you get 20% capital gains rate. And the dividends that you get, qualified dividends, follow the capital gains rates. I guess if you have those things in your personal life too, kind of thinking of that and how it influences your personal income when you add in your business. One of the things that you probably have noticed already on your most recent paycheck, if you are employed, which you may get a W-2 or you may not, but it will affect you for your end of the year self-employment tax, is that the Medicare part of your wages, it used to be 4.2% was being withheld. Now for 2013, it's 6.2%. So you're seeing a 2% increase in payroll taxes being withheld from your paycheck. And what this means to you as a business owner is at the end of the year, all your income goes through on your tax return, and you have to pay what's called self-employment tax on your income, as well as your income tax. And the self-employment tax is employee and employer portion of Social Security and Medicare that you have to pay as a self-employed individual on your personal tax return. So at the end of the year, you would have paid 13 and some percent last year. This year, it's going to be 15 and some percent that you're going to pay in. So you're going to see a 2% increase on that as it flows through onto your personal. And if your significant other is employed and they're saying, oh, why is my paycheck down? That's why, because the Social Security payroll holiday expired for 2013. Another aspect that came in is they call it the 3.8% Medicare surtax, which they passed during 2012 in effect for 2013. It's the 3.8% tax on high-income taxpayers. So this threshold is $250,000. So if you make over $250,000, if you have non-business income, which is if you have rent, it's called passive income, interest, dividends, and capital gains, and you make over $250,000, this 3.8% is an additional tax on that amount that you otherwise wouldn't have had. So if you kind of fall in that category and you have rental income or a lot of interest or dividends, that can be something that can come in to affect you as well. Another aspect that came in is the American Taxpayer Relief Act of 2012. And kind of the bummer thing about it is that it passed in 2013, but it affected things in 2012, which you would have wanted to have known what those rates and things were going to be in 2012, but you don't get to know them until 2013, and how helpful is that going to be as a business owner? So you could have planned to your heart's content, but you don't know what you're planning for because you didn't know what the tax rates were. So this is kind of, a lot of this is retroactive back to 2012 and what you're going to be filing here in the next couple months. So I'm going to kind of go through this, cover some high topics there. I talked about the individual income tax rates, the brackets, and a lot of people that I talked to were really worried about that and how it was going to change their taxes. But really, the takeaway from this is it didn't really change what your tax brackets were. They were set to expire and change, and they call it going back to the Clinton administration tax brackets. So really all you have to keep in mind is it didn't really change for me unless you're making over $450,000, and then it went up. But for the most part, you're pretty kosher from what you were for the last year. And that new tax bracket, I had sent out a handout before on what President Obama was wanting to do for that, and he was wanting it to be the highest tax bracket of $250,000, but he kind of got overridden in Congress, so it got bumped up to $450,000. So that's kind of a tweak from the prior thoughts of what it was going to be. Our next little topic is the marriage penalty relief, and this is a good thing that passed for everybody. And since we're all mostly married here, it increased what was set to expire, your standard deduction. When you're doing your tax return, you either get to itemize or have a standard deduction. itemized being your house insurance, real estate taxes, medical expenses, and certain business expenses as well. So it increased it to pretty much make it fair, where if you're married filing jointly with 2 people, it's pretty much the same as if you were married filing single separately. So it kind of evened the playing field there. Because before, you were getting pretty much penalized for being married and getting a lower deduction, whereas if you were to married being separate, you would get a higher deduction. So that's just one thing you won't notice the change, because it's the same as prior years. It's a little higher standard deduction for the cost of inflation, but you won't really notice that. And one of the biggest things that affects more and more taxpayers, and I don't know how familiar you are with this, is the alternative minimum tax. It's a wonderful thing that I say wonderful, but the government wanted to kind of even out how much tax middle income people were earning. So it wasn't even hitting high income people, it was hitting single people with income between $30,000 and married people with $70,000 of income. So it's people with moderate income that this was affecting. And what it is it kind of removes the brackets for people. It does a comparison of your income tax with your brackets versus if you were just to pay a flat 28% on all of your income with some adjustments for different things taken out and added back in. So it adds, for some people, a couple $1,000s extra tax onto your tax return just because of this AMT, they call it, alternative minimum tax, to kind of get rid of the brackets, which kind of doesn't make a whole lot of sense. So every year they were having to, they call it patching it, and increasing this exemption that people would get. And they, this year, okay, well, we'll bump it up a little bit and we'll cut out those people and try and keep it there. But it was never permanent on this exemption. So for 2012, up to January 2nd, 2013, this rate was supposed to drop, and pretty significantly by half. And a lot more people were going to fall into this alternative minimum tax, which would not have been good for the economy and for business owners, taxpayers. You would have ended up having to owe a significant more amount of tax if you fell into that category. And what Congress finally decided, and through, I think, letters from accountants and people to the Congress to get them to pass a permanent patch on AMT, the alternative minimum tax, to get them to keep this higher exemption, to keep people out of paying this alternative minimum tax, and increase it each year automatically for inflation. So it's a good thing that they passed it, and it's kind of a more complicated area of taxation, but if you have more questions on that, I would love to sit down and talk to you about it, because I don't like it. Anyway, on that note, it was a good thing that it passed. The next thing is the Pease Limitation. This is a thing that it got suspended with the Bush-era tax cuts, and really what it is it hits high-income taxpayers less than the other ones. So if you have income over $300,000, married filing jointly, your itemized deductions start getting reduced by 3% of your amount over the threshold. So it's a complicated calculation once you get to it. But really, if you have over $300,000 married filing jointly, your itemized deductions can get limited to not more than 80% of your itemized deductions. So that means if you have higher income and you had originally $100,000 of deductions, they're going to limit it to only $80,000 of deductions. They're just kind of throwing a limit in there to make you pay a little bit more in tax. So the kind of going forward with all the different things that I take away too, kind of keep in mind mostly just the thresholds. So you don't really have to think about the different aspects and how you calculate it, but keep in mind, like for this one, the $300,000. If you happen to hit in that area, once you are planning out your year, doing your budget, how can certain things I do affect that going forward? So that's something to keep in mind. If you don't make over the threshold, nothing changes from the prior year. And that's really one of the main things that you can take away too. I think a lot of the news media has hyped it up on all these different changes and how you're going to get hit here and there, but it's also key to think about the different things that are changing and how you aren't affected by that versus the other way around. A majority of our clients aren't really affected by a lot of these things. And then along those same lines with the itemized deductions, is the personal exemption phase out. This is, again, the same threshold for the itemized deduction is $300,000 for married individuals. And what it is you have, it's after your itemized deduction, it's an exemption for each individual that you're claiming on the tax return. So if you have you, your husband, and any children you have, those would be your personal exemptions. So if you have over the $300,000, then you get your, it's another one of those crazy calculations. It reduces 2% of the deduction by the amount you're over the threshold. Stuff I like to do, but you don't really need to worry about that too much. I don't know, I think I have like a little gene in me that likes numbers, so I could go off on numbers for a while. So just another thing, keep in mind just the threshold, and if you are over that threshold, how it could affect you going forward for that. Another aspect for the estate tax, if you're familiar with that, if you are to pass away and you have your estate, which is things you own, investments, your house, different properties, it has to go through your estate. For 2012, it was scheduled to be $1 million of estate that you could have and not get taxed on it. Anything above that, 55% of your estate would get taxed. Yeah, it was ridiculous. And $1 million. And a lot of it hit farmers. I don't know if you know many farmers, but there's a lot of them here. Their farm ground is significantly, worth a lot of money. And that's usually where the farmers would get hit. Because if your inheritance, you get this farmland, you have 55% tax to pay on it. You don't have cash because you got farmland. You're going to have to sell off your farmland to pay the inheritance tax. When you think about it, it was really the farmers that got hurt, and people that have significant amounts of property that they want to keep in their family, but to pay the estate tax on it, you had to sell it off just to pay the tax on it. So Congress wised up, I would say, and they adjusted it to $5 million back to what it was in the prior year. So if you have assets under that, you don't need to concern yourself with that. It'll pass through with the exemption, and you don't have to burden your family members with any tax on that. So it's really great to kind of keep in mind too, if you have that rich uncle that everybody hopes they have somewhere, that if you were to have under $5 million in assets, they could pass to you without the tax on those. So something good to keep in mind. On that light too, I kind of wanted to bring in the gift tax. I don't know if you're familiar with gifting rules, but you're able to gift a certain amount of money to people, and they don't have to claim it as income, and you don't have to do anything with it either. And it's called just gifting under the limitation of the estate tax. So you have $13,000 or so that you can give. You can give $13,000 to you, $13,000, $13,000, $13,000, without them having to pay tax on it, and without you having to pay a pre-estate tax on it. So that's something, just kind of keep that in the back of your mind on different options of how you can help your family members without burdening them or ending to burden yourself with gift tax on that. So I know I'm throwing a lot of different stuff out here for you, but just to keep these things in mind as you come across them. You're not going to come across everything that I talk about, but there's certain topics that may stick in your mind when you're going through, and just to think about them as you come across them. Retirement savings. This is kind of a key thing to keep in mind. You all are probably familiar with putting into your retirement. You have until you file your taxes to put money into a retirement for tax savings from the prior year. So you're in 2013 now. You have until April 15th to make that contribution into your 401k if you haven't done it yet in 2012, or your self-employed savings plan for that as well. But one of the things is your traditional 401k plan, you put money into it and you don't have to pay income tax on the money you put in. So it's just a deduction that you get, your standard 401k. Now you also have a Roth IRA that you put money in but you don't get the deduction for it. And the difference between the two is when you take the money out. So your standard 401k, when you take the money out, you pay tax on it. So, you're putting money into it. 20 years from now, you're going to pay the tax on it. Who really knows what the tax rates are going to be then? You're kind of making an assumption that it's helping you now by taking the tax savings versus when I take it out, and kind of planning it that way. The Roth IRA, when you take the money out, it's not taxable because you've already paid the tax on it. And there's certain other little caveats with that too, but the IRS is allowing, if you've decided that you would rather pay the tax now instead of when I go ahead and take it out, you have the ability to do a conversion now and pay the tax on what you put into your 401k now, and instead of postponing the tax till later. So that's something, if you have those thoughts and different planning options for that as well, it might be a good idea to talk with a financial advisor before you make a bunch of those decisions. If you have children, you have the $1,000 per child under 17 deduction credit for your tax return. So that was set to go to $500 in 2012, which you could have been planning on all year in 2012, only getting $500. So now they're worth $1,000. So, and that is set to continue, so it's more permanent than what it was before. So another one that a lot of people, it affects business owners too, that may have gone back to school or have education expenses. They extended the American Opportunity Tax Credit as well. If you had it before, nothing really changed. You still get up to $2,500 in education credit if you have qualifying expenses for that. Another thing, if you have student loan interest, this was another thing that was set to expire, where you get a certain deduction for student loan interest. It was set to be only on the first 60 months of your repayment. Student loans, you can pay up to 10 years, the government ones, so that would significantly cut a large chunk of your interest off of that. So they have extended it to just be any student loan interest. They removed that 60-day window, so that's also good news. All right, that was an overview of most of the individual provisions, things that have changed. I know it's dry and awful, but for the individual and from the business owner perspective, knowing the way that your personal items are going to be taxed will give you a better idea of how, when your business flows through, of how much really you'll have left for your business after the different tax items affect it. Because as small business owners, that's where it's going to hit you, is personally when you do your taxes and get that through. But I did want to cover the business specific items. One of the major things is what they call Section 179 immediate expensing. And what that is if you buy equipment or furniture and fixtures, tables, computer, generally, if you didn't have this immediate expensing, you'd have to take a deduction over 5 to 7 years for the cost of that computer. So $500 computer, 1 year, you're taking a $100 deduction. Next year, $100, $100, $100 until you've used it all up, which is the way accounting is supposed to work. But if you want to spend this money, you want the cash flow to spend it, you want to get the tax savings right when you spend it. So the 179 immediate expensing says that you can immediately write off the cost of that equipment, that furniture, against your income for the business all in that 1 year, which is great for taxpayers and business owners that don't have the cash flow to pay the tax under the standard write-off over a certain number of years. So you're starting to invest in your business, you're putting equipment in there, you want to get that tax write-off as soon as you can instead of postponing it. So that's a really great thing to have. And for larger business owners, originally you could only write off up to $139,000 of equipment. Farmers, their equipment, just one piece of equipment could cost that much. So how much could that really help them with that limit? When they passed the 2013 on January 2nd, they retroactively went back and said, okay, you can have $500,000 of immediate write-offs, which it's after 2013. If you haven't already purchased it, it doesn't really help you. It's kind of a catch-22 there. But then they also extended it through 2013 to have the $500,000 of immediate write-offs with inflation in there as well. And also, in association with that, another aspect of immediate write-off is called bonus depreciation. And what that is, it was in 2011 similar to the 179 where you got to write off the entire thing. But for 2012, you get to write off certain new business property, 50% of it you get to write off in the 1 year. So there's significant different tax planning aspects that you can do, combining the 179 with the 50% bonus and different things. But knowing it exists for your tax planning purposes of being able to write that off at the end of the year versus having to spread it over a certain period of time is really good to know. If you have employees, there is also, they extended the work opportunity tax credit. And that really is just basically, there's certain high-risk employees that they're encouraging employers to go out and hire. It could be certain length of time that they've been unemployed, military. There's a list of different ones, but if you are to employ them in your business, you can get a 40% tax credit for their wages that you paid them, up to $6,000. And that's just on their first year wages. If you're wanting to help the community and you're going to hire these people anyway, you could possibly have a tax credit there as well. And then there's the good old energy incentives. One thing to note that a lot of people hadn't understood is that you were limited to a lifetime credit of $500 for your energy improvements. So, you go to buy windows and your window salesman say, oh, hey, yep, you can get this credit for buying this window or this special door. If you've already taken that credit in years past, you might not actually be able to get that credit because there is that $500 limitation. Really, what a home-based business you can write expenses off for is if you have just a Schedule C business with income that you're running through personally, you're paying the expenses and getting the income. This is just an add-on onto that you're able to have these additional expenses that you incurred because you had this business in this room of your house. So it's good to know that that deduction exists to be able to get that offset. $5 per square foot up to $1,500 credit to offset your income from your business. There are certain IRS stipulations. Generally, say it's a separate room that you use or half of a room that you can measure the square footage of and its sole purpose is business related, then that's your business use of home square footage that you would use for things like that. A deduction is, so you have your business income. Anything you've got receipts for selling your products or providing your services is your income. Your deductions are your business expenses that you've incurred to produce your service or produce your product. So your deductions are, well, car mileage, yes, you'll have your travel expenses, office supplies, your different bank fees, interest, different things. What else we got? What else? Yeah, paint supplies. Yeah. Yes, if you take your client out for a meal to sit down one-on-one with them, things like that. Yes, your cell phone expenses, yes. Your business insurance? Yes, yep, that's also a deduction, yes. And there's special treatments for if you have health insurance that you're paying as well and how that can get, we'll cover that. That's another thing. So that's, your deductions. So deductions decrease your income, dollar for dollar. Offset it there. So get your net income. Credits, on the other hand, are what reduces your tax liability after you've calculated everything to get to your tax. If I were to have a $1,000 deduction or a $1,000 credit, I would much rather have a $1,000 credit, because a $1,000 deduction is only going to reduce my taxable income. So, I get a $1,000 deduction, I'm only reducing my tax by my percent of that deduction. Versus a credit, I have my tax that I owe. Okay, I owe $500. I have a $300 credit that I get, then I only have to pay $200 in. So you get a dollar for dollar reduction in your tax. Credits are great. So if you are looking around and you see a credit for doing this certain thing for your business, pay more attention to that and see how you could get that credit versus if it was just a regular deduction. So knowing the difference between those, I think is, yeah, that's a great aspect of considering it. Yeah. Just another thing to mention as well is the tax filing for e-filing with the IRS. They're not accepting e-filed returns, or paper returns for that matter, until January 30th at the earliest. If you have a W-2 or if you have all your stuff together right now and you wanted to file your taxes, you can't until January 30th. You can always prepare them and get them ready to go and have them sitting there, but you can't hit the submit button until the 30th. But for you as a business owner, if you have fixed assets, depreciation, passive activity, if you have rental activity, you are actually not going to be able to file until late February, middle of March, which is pretty significant length of time for them to have to get these forms ready and everything, especially if you're an S corporation when your tax return is due March 15th. You can always get your stuff ready. I would encourage you to get it ready now and have everything set to go. But if you're expecting to have your refund 2 weeks after you get everything ready, you can't actually file to get your refund until those certain dates. So I thought that would be worth mentioning. I mean, I could go on and on and on and on about different tax aspects. Are you keeping track of your mileage every day on this is where you go, this is how far it was, this is who you went to see? The IRS released their new standard mileage rate for this year is 56.5 cents per mile you travel. So what that means, you have a couple different ways. You can do just keep your track of your standard mileage that you're traveling, business purposes. So you're traveling to go to meet lunch with somebody, or you have to go get a supply from this provider, or go to see this client. You're keeping track of the date you went, how many miles it was, who it was with, and you're keeping that log through the year of those, and then you total them up at the end of the year, and for every mile you went, you get 56.5 cents deduction on your return, which is significant, you know, because you're not thinking when you're driving around, you know, this mile, here's 56 cents, so there's 56 cents. You don't really think about it, but it gets a significant amount back for people at the end of the year that have kept track of it. The other way, which is a little bit more burdensome for people to keep track of mileage, you still have to keep the log no matter what, but you would also have your vehicle that you could depreciate the cost of your vehicle based on the percentage of business use versus personal use. The fuel, you'd have to keep all your fuel receipts, any vehicle repairs, tires, car insurance, keep track of all of that, and then get a percentage of business use deduction on all of that. If you have this information on whatever you decide to use, whether it's just a journal, a day planner, Excel spreadsheet, you just need the date, the person, the miles you went, and what was discussed. And having that information just in any form, really, if you get in front of an IRS auditor, just the fact that you have that with you, you kept track of it, they're more likely to take your, accept your mileage for that. So you can kind of compare one way or the other, but once you have one vehicle and you start doing it one way, you can't change. So at the beginning, you want to figure out which is best for you, but just knowing the differences. And if you're just going to go standard mileage and not do your fuel, just keep track of your miles. Or if you want to do the other way, you need to keep all your receipts for everything as well. Thank you for taking the time to view the video today, and I hope you found the information helpful and pertinent to your business uses. If you have any additional comments or questions, you can contact me at the information below, and I look forward to hearing from you.